In the pantheon of financial titans, few names resonate with the authority and respect accorded to Warren Edward Buffett. Known as the Oracle of Omaha, he has redefined what it means to be an investor not through high-risk gambles or fleeting trends, but via a disciplined, value-driven approach that has amassed a fortune exceeding $100 billion and shaped generations of financial thinkers. Born on August 30, 1930 in Omaha, Nebraska, Buffett's journey from a precocious paperboy to the chairman and CEO of Berkshire Hathaway is a masterclass in patience, rationality, and the power of compounding wisdom. Buffett's early fascination with numbers and business emerged in childhood. At age 11, he made his first stock purchase, 3 shares of Citi's Service Preferred at $38 per share, an experience that taught him early lessons about market volatility and emotional control. By high school, he was already running small enterprises, delivering newspapers, selling gum and Coca-Cola door to door, and even operating a pinball machine business with a friend. These ventures weren't mere hobbies, they were laboratories for testing entrepreneurial principles, cost analysis, customer behavior, and profit margins that would later underpin his investment philosophy. After graduating from Woodrow Wilson's, Buffett enrolled at the University of Pennsylvania's Wharton School, but soon transferred to the University of Nebraska-Lincoln, where he earned his bachelor's degree in business administration. Unsatisfied with conventional business education, he sought mentorship from Benjamin Graham, the father of value investing and author of The Intelligenters. At Columbia Business School, Buffett studied under Graham, absorbing his core tenets. Invest in companies with strong fundamentals, buy when prices are below intrinsic value, and maintain a long-term horizon. Graham's emphasis on margin of safety, purchasing assets at a significant discount to their true worth, became the bedrock of Buffett's strategy. Post-graduation, Buffett returned to Omaha, where he launched his first investment partnership in 1956 with $105,000 in capital from family and friends. Operating from a modest office, he applied Graham's principles rigorously, seeking undervalued companies with sustainable competitive advantages. One early success came with the purchase of a struggling textile mill, Berkshire Hathaway, in 1965. Though initially viewed as a value play, Buffett soon recognized the textile business' structural decline. Rather than abandoning the company, he repurposed its cash flows to acquire other businesses, transforming Berkshire Hathaway into a diversified holding conglomerate, a move that would become his signature innovation. The 1970s marked Buffett's evolution beyond pure value investing. He began prioritizing companies with durable competitive advantages, brands, pricing power, and consistent earnings, even if they weren't temporarily cheap. This shift led to landmark acquisitions. Seascandy's 1972, a California confectioner that demonstrated the power of pricing discipline and brand loyalty. The Washington Post 1974, a media giant purchased during a market downturn, yielding multifold returns. Geico major stake in 1976, an insurance company whose underwriting expertise aligned with Buffett's focus on predictable cash flows. By the 1980s, Buffett had refined his approach into what is now known as Buffett-style investing. Buy great businesses at fair prices, hold them forever, and let compounding work its magic. His 1988 acquisition of Coca-Cola stock, a company with global distribution, iconic branding, and steady dividends epitomized this philosophy. Over decades, that stake grew into one of Berkshire's most profitable holdings. Berkshire Hathaway's structure became a model for capital allocation. Instead of paying dividends, Buffett retained earnings to reinvest in new acquisitions or repurchase shares when undervalued. This flywheel effect accelerated growth. By 2000, Berkshire's stock BRK.A traded at over $50,000 per share, up from $27.50 in 1965. Key acquisitions in the 2000s, like Sprailway 2009 and Precision Castarts 2015, further diversified the portfolio, while minority stakes in Apple, American Express, And Bank of America showcased his adaptability to tech and financial sectors. Throughout his career, Buffett maintained an uncommonly transparent relationship with shareholders. His annual letters to Berkshire investors, written with wit and clarity, became required reading for finance professionals. He demystified complex topics, insurance float, economic moats, and management incentives, while emphasizing timeless principles. Think like a business owner, not a trader. Ignore market noise, focus on fundamentals. Be fearful when others are greedy, and greedy when others are fearful. Never lose money. His partnership with Charlie Munger, Berkshire's vice chairman, proved pivotal. Munger's legal acumen and broader intellectual curiosity pushed Buffett to consider qualitative factors, brand strength, management integrity, and industry dynamics, alongside quantitative metrics. Together, they built a culture of rationality, eschewing fads like dot-com speculation in the 1990s, a decision that spared Berkshire from the tech bubble crash. Beyond finance, Buffett is renowned for his frugality and authenticity. Despite his wealth, he lives in the same Omaha home he bought in 1958 for $31,500, drives modest cars, and enjoys fast food. His philanthropy, however, is monumental. In 2010, he pledged to donate 99% of his wealth to charitable causes, primarily through the Buffett Foundation and via grants to the Gates Foundation. His Giving Pledge initiative, co-founded with Bill and Melinda Gates, has inspired hundreds of billionaires to commit their fortunes to social good. Personal milestones punctuate his story. His marriage to Suzanne Buffett, later a prominent philanthropist, and subsequent relationship with Astrid Foxbutt have been part of his public narrative. His 3 children, Susan, Howard, and Peter, have pursued careers in philanthropy and agriculture, reflecting the family's commitment to stewardship. Today, Warren Buffett's legacy extends far beyond net worth. As a teacher, has educated millions through his writings and interviews, democratizing investment knowledge. As a capital allocator, has proven that patience and discipline outperform short-term speculation. As a philanthropist, has redefined how the ultra-wealthy can contribute to society. His life embodies a paradox. A man who mastered the art of making money yet measures success not in dollars, but in integrity, impact, and the joy of compounding, both financial and human. From a Nebraska paperboy to the world's most respected investor, Buffett's story reminds us that true wealth isn't merely accumulated, it's cultivated through wisdom, ethics, and a relentless commitment to value. In an era of instant gratification, his example stands as a beacon. Greatness isn't built in moments, but in decades of quiet, deliberate choices.